Chapter 12 is on differential analysis, the key to decision making. This chapter I chose to be the last chapter for our semester because it kind of takes everything that we've learned all semester and we get to actually start analyzing things and making decisions based on what we've been looking at all semester. The first thing that we're going to do is we're going to look at relevant and irrelevant costs and the benefits that these costs have in making a decision. There are 6 concepts that we want to look at first to kind of help us choose which costs we want to look at when we're doing this analysis. The first one is you need to define the alternatives. What are you looking at? Are you looking at adding a product line or staying the same? Are you looking at taking away a product line or staying the same? Are you looking at processing something further? Or what is the product mix that you want to have? What are the alternatives that you're making a decision for? Then the second concept is to look at relevant costs and relevant benefits. If it's not relevant to the decision, you don't need to look at it. And then you want to look at, this is a very important one, is the differential analysis. You don't want to look at what's happened in the past. You don't want to look at what's happening now. You want to look at, if I make choice A, what are my costs going to be going forward? What are the benefits going to be going forward? As opposed to if I choose B, what are the future costs and what are the future benefits? You want to look at the future, which is going to be the ramifications of your decision. You don't need to look at what happened in the past or what's currently happening. A differential cost is just the cost that differs between any 2 alternatives. For example, if alternative A had a cost of $7 and alternative B had a cost of $10, the differential cost is $3. The same with differential revenue. This time, let's say alternative A has revenue of $7 and alternative B has revenue of $10. The differential revenue in this case would be $3. An incremental cost is an increase in cost between the 2 alternatives. And then an avoidable cost is the cost that can be eliminated by choosing one over another. So if you chose A, you would not have the cost of $6. But if you chose B, you still would have that cost. That would be an avoidable cost. We can avoid this cost by choosing A. Then we have sunk costs. Sunk costs are always irrelevant because a sunk cost is something you've already spent money on. You can't go back and you can't take these costs back. They've already happened. Forget about them and move forward. A sunk cost is already incurred. It's not going to change whether you choose alternative A or alternative B, so you don't need to include it in your analysis. And key concept 5 is future costs and benefits that do not differ between alternatives are irrelevant. So what this means is if you choose alternative A, you have a cost of $3, and if you choose alternative B, you also have a cost of $3. Because they both have the same cost, you don't need to include the $3. You only want to include anything that is different between the 2. And then the last one is opportunity cost. You do want to include opportunity cost. The only problem with that is sometimes it's hard to quantify. An opportunity cost is what you give up to choose one alternative over another. It's the potential benefit that is given up when one alternative is selected over the other. An example would be going to school. The benefit is you're getting an education to further your career, but by going to school, you have the opportunity cost of not working or of spending more time with your family or your friends. Those are examples of opportunity costs. Okay, we're going to look at this one example here of, we're going to figure out what she should do. She is a student at a Boston college and she wants to go visit her friend in New York. And she can either drive or she can take the train. And we need to help her make that decision. By car, it's 230 miles to her friend's apartment. She's trying to decide which is less expensive. So you can make this choice on so many other factors, but her factor is which alternative is less expensive. So that is the only thing that we need to concentrate on. Okay, and listed here are her automobile costs, and this is based on driving 10,000 miles per year. Depreciation is $2,800 annually, and so that's 0.28, so it's 28 cents per mile. Cost of gasoline is 10 cents. Her annual auto insurance and license is 13 cents, almost 14. Maintenance and repair is 6 cents. Parking fees at school is 3 cents, and then the total average cost is 61.9 cents. I know it's 0.61, so it's 61 cents, almost 62 cents if you round it. Okay, this is just how they came up with those costs. Okay. Some of the information here is relevant and some is irrelevant. And we need to decide between the two which is relevant or which is irrelevant. But before we do that, we do want to look at this additional information. The first additional information we want to look at is the reduction in resale value of her car for each mile of wear is 0.026 cents. Her round trip train fare is $104. The cost of putting the gone in the kennel while gone is $40. And then the cost per day of parking in New York is $25. Then we have some benefits that are not quantifiable. And that is relaxing on the train trip. And when you're driving, you don't necessarily get that relaxation. The benefits of driving a car in New York. And then the hassle of parking the car in New York. Those are also other information that we have. But remember, her goal was to find the one that was least expensive. Okay, now let's look at which costs are relevant and which are not relevant. The cost of the car is a sunk cost, whether she goes or not, or however her transportation is going to be when she goes, it is irrelevant. It's a sunk cost. She's already bought the car. The cost of insurance is also not relevant because she's going to have the insurance regardless of whether she drives or takes the train. The cost of gasoline, however, is relevant because if she chooses to drive, she's going to have that cost. Maintenance and repairs is also relevant because over time, it's going to add to her miles. It's going to have a factor with the miles driven. The school parking fee is not relevant because she has to have that regardless of whether she goes or not. So at this point, we can see that some of the average cost is relevant while others are not. The resale is value that declines is relevant. The train fare is obviously relevant. Relaxing on the train is irrelevant because it may play a factor in making that decision. However, this decision is going to be based purely on whatever is least expensive. And the kennel cost also, because she's going to incur that regardless of whether she takes the train or the car, because she's going to kennel while she's gone. The cost of parking in New York is relevant because if she takes the train, she doesn't have to worry about that. And then the benefits of having a car in New York and the problems finding parking space are relevant, but you can't assign them a dollar amount, therefore we're not going to consider them. Okay, if you take the cost of driving, you have the gasoline, 460 miles because it's 230 one way, so 460 round trip is $46. Maintenance on the car is going to be $29.90. Reduction in resale is $11.96. Parking in New York for 2 days is $50. So the cost of driving is a total of $137.86. A round trip ticket for the train is $104. So therefore she should take the train just based on that information. Okay, now we're going to look at the differential cost approach. In this example is when you're just looking at the difference. What's the difference between the current situation and the new situation? So for this one, the management company is considering a new labor-saving machine, and it's going to cost $3,000 a year to rent. So in this first column, we have the current situation. We have 5,000 units that we sell at $40 a unit. That's $200,000. And if we use this new machine, we still have the same sales. Therefore, the differential costs and benefit is nothing. Okay, the variable costs, the direct materials, the direct labor, and the overhead will still incur. However, the materials and the overhead will stay the same, so the differential cost is 0. But this machine saves on labor. So instead of labor being $40,000, under this new situation where they rent this machine for $3,000 a year, labor is only going to be $25,000. The difference between $40,000 and $25,000 is $15,000. That is the differential cost or benefit. Okay, so the variable expense, the total variable expenses are going to differ by that $15,000. And then take your sales minus your variable expenses, and you know that that gives you the contribution margin. We have a higher contribution margin under the new machine by $15,000 because we have $15,000 less in variable expenses. Okay, looking at the fixed expenses, we're still going to have the $62,000 of fixed expenses. So again, there is no differential cost or benefit. The other fixed expense is the rent on the new machine, which is $3,000. We have 0 under the current situation, $3,000 under the new situation, which is a differential cost of $3,000. We will incur $3,000 more in fixed expenses if we go to the new machine. If you take the $15,000 contribution margin of the differential benefit, subtract the $3,000 rent on the machine, and we get net operating income of $12,000 increase if we choose to use this new machine. And this just sums it up the same. We will save $15,000 in labor costs. We will incur a $3,000 rental fee, which is a financial advantage of running in the new machine, will be the $12,000. Okay, the next analysis that we're going to look at is whether a product line or other business segment should be added or dropped. One thing you do want to look at when you do this is the financial implications of it. This is usually the main reason why you want to choose to drop a product line or not. And the product line that we're talking about are digital watches. As you know, most of us have phones, which tells us the time, so we don't wear a watch. We may have an Apple Watch that goes along with our phone, but we don't wear the actual real digital watches that people wore before cell phones. They still sell some, but they notice that they're having a decline and they're losing money. So we need to help them figure out whether they should keep the digital watches or not. And the decision rule to make that choice is they want to drop the digital watch segment only if its profit would increase. If the profit stays the same or the profit decreases, they don't want to do that. And one of the best ways to do this type of a comparison is to look at the contribution margin. We're going to look at the contribution margin that would be lost if the digital watch line was discontinued, because a lot of the fixed expenses would be avoided if the product line was discontinued. Oops. Okay, this is a simple income statement for the digital watches. You see that they have sales of $500,000, and then they have variable expenses of manufacturing costs, shipping costs, and commissions, which is $200,000, which gives them a contribution margin of $300,000. And this is the part that goes towards the rest of the company. Looking at the fixed expenses, they have $400,000 fixed expenses, which gives you a net operating loss of $100,000. So you can see why they're looking at trying to take this portion of the business away. Okay, when the company did some investigation, they revealed that the fixed general factory overhead and general administrative expenses would not be affected by dropping the product line. The fixed general factory and the general administrative expenses would be reallocated to other product lines. So these are two fixed expenses that we would still have even if we drop the product line. The equipment to make the digital watches has no resale value or alternative use. So should they retain or drop the digital watch? If you're looking at it through the contribution margin solution, you want to look at the differential cost here. So if you dropped, let's start with the contribution margin that would be lost. They had a contribution margin of $300,000. If they dropped this product line, they would not have that contribution margin anymore. That's why it's a negative $300,000. Then the fixed costs that can be avoided add up to $260,000. That still leaves you shy of $40,000. So it is a financial disadvantage if they drop the line. If they dropped the product line, their net income would actually decrease by $40,000 because of some of the fixed expenses that they still will have if they, even if they dropped it. Okay, now let's look at it from a different approach. Let's look at it from the differential approach, the difference. Over here we have our sales and less our variable expenses. If we drop the digital watch, we wouldn't have any of those. Therefore, the difference will be that exact amount. Okay, then looking at our fixed expenses, the general factory overhead we would still have under both. And then the depreciation here is the same, so that is $0. The salary of the line manager is $90,000. If we drop the product line, we wouldn't have that, so that's a difference of $90,000. advertising we would not have, and the rent of the factory space we would not have. So that goes over in the difference column as well. You end up with total fixed expenses of $260,000, same as the first approach we did. So regardless of the method you use, you should still come out with a financial disadvantage of the $40,000. Okay, you still might be thinking, okay, they're losing $100,000. Why would they not want to drop it? Well, some of it is in the common fixed costs, and we've talked about that before. There are costs that the company has that are common for all of the different segments of the business. And if you drop one of the segment of the businesses, you still have that cost, and that cost is just going to be allocated to the other parts of the business. So that helps in decreasing your net operating income. Okay, now let's look at making or buying. This is another analysis that we're going to do. And this is whether we should continue to make a product or a part that goes on the product, or whether we should buy it instead. Some of the advantages to doing this, to making the part, is you have a smoother flow of parts and materials because it's all in-house. You have better quality control because you're the one who is making the decisions about the product and watching it being made. And then also you can realize some extra profits. Some of the disadvantages is that you can't maintain that competitive position with economies of scale. If you make that part better and cheaper than everyone else, then go ahead, do it. But if you don't, let that other person doing it. So a disadvantage of doing it is you're not taking advantage of the economies of scale. Okay, in this example, the unit product cost of this part we're looking at is $30. So that is the product cost. The equipment has no resale value, and the total amount of general factory overhead is allocated based on hours, and that would be unaffected by this decision. The $30 unit product cost is based on 20,000 parts produced each year, and an outside supplier has offered to provide those 20,000 parts at a cost of $25 per part. Initially, you might think, okay, well, if the cost to make it is $30 and we can buy it for $25, that's an easy decision. We're going to buy it instead. But you're leaving a lot out if that's how you make your decision. If we buy these parts, we buy 20,000 at $25 each. That's $500,000. That will be our total cost. Taking the $30 and multiplying these costs that make up the $30 by 20,000, you get 340. You can actually, So 9 times the 20,000 is 180. 5 times the 20,000 is 100,000, and so on. You get 340. So we save $160,000 by making it ourselves and not having them buy it from an outside supplier. So we do have a financial advantage of the 160. Okay, let's go back and talk about opportunity costs. They're not actual cash outlays. Sometimes it's a non-monetary opportunity cost. But in looking at this part that we were considering buying from another supplier instead, if we did buy it from them, then we would have some employees, we would have some space, and we would have some machines that we could use for something else. And so that is another part that we can look at. Okay, special orders. Special orders is the next analysis that we're going to look at. This is a one-time order where a potential customer comes up to you and says, hey, I have this special order that I would like you guys to make. And so it's usually a bulk order, and they want it at a discounted price because it's such a large order. We're going to look at whether we should take on this order at the lower price or not. Before actually going into calculating whether we should do this, there are a couple of other things that we want to look at. One is, do they have the capacity to take on this extra order? Their annual capacity is 10,000 units. They're currently only selling 5,000 units, and this one-time order is 3,000 units, so they have enough capacity to do it. And this product normally sells for $20, and they're saying that they want to purchase it for $10. But it is a large order, so we want to see if we want to accept the offer or not. Okay, if you look here, 5,000 units at $20 is $100,000. That's what their revenue is. Their total variable costs are $40,000, and if you take that and divide by 5,000, you get $8 as a variable cost. We're going to need that number to for the next slide to look at it. Okay, if they take on this special order, it will be the $3,000 times the $10 per unit. They will earn an additional $30,000 in revenue, but they will also incur some costs. They won't incur any more fixed costs because they stay the same regardless how many. But they will have some variable costs. They will have $8 of variable cost times that 3,000. That's 24,000. If you have a positive number, if your revenue is more than your cost, then it is a financial advantage and they should accept the order. Even though they're selling it at a reduced price, they will still earn an additional $6,000 above their cost for taking on this order, so they should do it. Okay, we will look at another example of this. Here we have Northern Optical. They ordinarily sell the X lens for $50. Variable production cost is $10, and then fixed is $18. The variable selling cost is $1. The customer wants to place a special order for 10,000 units. And let's look at whether we can do that. The variable production cost is $100,000 plus the additional fixed cost that they would incur gives you the total relevant cost of $150,000. Divide that by the number of units, and then the average cost per unit is $15. The next analysis we're going to look at is volume trade-off decisions. This is when they do not have enough capacity to produce all of the products and sales volumes demanded by their customers. How do they choose which product to make? So if you have two products and you can only make so many of each, and you know what the demand is, how do you make that choice as to which ones to make and how many to make? The goal is to maximize profit. So we need to find a way to figure out what is the perfect combination between product A and product B that will maximize our profit. Now, sometimes what happens is you will have some sort of a constraint. You will have a bottleneck which is a part of the manufacturing process that slows things down. And if that could be eliminated, then you can produce more units of both. Fixed costs are usually unaffected by this because we're looking at just this one certain constraint. Here we have two products. The selling price for product 1 is $60, for product 2 is $50. Less their variable expenses gives the contribution margin for product 1 of $24 and the contribution margin for product 2 of $15. The contribution margin ratio is 40% for product 1, only 30% for product 2. In this constraint, in this bottleneck, the processing time on this machine, which is machine A1, product 1 needs to be there for 1 minute. Product 2 needs to be there for half a minute. This is the most important information that you need to figure out which you should do. Okay, machine A1 is operating at 100% capacity, so we cannot add any more to it. It only has a capacity of 2,400 minutes per week. 1 minute can produce 1 of product 1 or 2 of product 2. Let's see which generates more profit. Okay. The contribution margin for product 1 is $24. So they earn $24 every minute in there. Product 2, the contribution margin is $15. So they can make 2 units in machine A1 at $15 contribution margin per unit, and that is $30. So in 1 minute of machine A1, they will earn $24 in contribution margin for product 1, $30 in contribution margin for product 2. They earn more making product 2 because they can make twice as many. Take the contribution margin and divide it by the time they are in that constrained resource, and you get your contribution margin per minute. The contribution margin is very important, but when you're looking at a constrained resource, you want to find the contribution margin per the constrained resource. Here for product 1, it's $24, and for product 2, it is $30. Product 2 should be emphasized. You should fulfill all of the customer demand for product 2, and then anything left over, make product 1. The demand for product 2 is 2,200 units, and then times the required time in that bottleneck, that constrained resource, is a half a minute. The time required to make product 2 and fulfill the demand is 1,100 minutes. Now remember, they have 2,400 minutes available. They only need 1,100 to fulfill the demand for product 2. Subtract the 2,400 from how many minutes it's going to take for product 2, and you get 1,300 minutes. You will spend the remaining 1,300 minutes making product 1. Making 2,200 for product 2 times the $15 contribution margin gives you a contribution margin in dollars, $33,000. And for product 1, $31,200. One more decision you can make with a constrained resource is how much would you be willing to pay for an additional minute of the constrained resource. The contribution margin for product 1 was $24. That is the lower of the two contribution margins. For an additional minute, you would be producing product 1 because the demand for product 2 has already been met. So you would be willing to pay up to $24 per minute to add one more minute of with the constrained resource. Okay, let's look at the split off point. This is when you have a product and you can either sell it as is or you can process it further. When you have two or more products together that you can produce, they're known as joint products because they come from the same raw material input. The point where the joint products can be recognized as a separate product is the split off point. And then at that split off point, you want to decide whether you process it further or you sell as is. A good example of this would be oil. You can drill for oil and sell it as is, or you could refine it and you can make it into gasoline, or you can make it into other chemicals such as heating oil, lubricants, asphalt, and various different organic chemicals. You can look at the relative sales value for this, but that's not necessarily the best decision to make. What you want to do is you want to look at what is the incremental revenue that you are going to earn from processing it further, and what is the incremental costs that are going to be incurred from processing it further. And then subtract the two, subtract the additional income, subtract the additional cost from the additional income, and then if you have a positive number, yes, you should process it further. So let's look at this one example. We have a lumber, and per log, the sales value at the split off point is $140. You can have also the sawdust, which at split off point is the sales value is $40. The sales value after processing it further is $270. The costs are $176. So the cost of further processing is $50. For the sawdust, the sales value after further processing is $50. So they can sell it for $10 more if they process it further. The joint products costs allocated, that's $24, and then the cost of further processing is $20. The revenue that will be added if they process the lumber further is $130. The cost of further processing is $50. So they have a financial advantage of $80 if they process the lumber further. On the other hand, the sawdust has a sales value of $40, and that's a $10 increase. That's a $10 incremental revenue. The cost of further processing is $20, which leaves a financial disadvantage of $10. If they process further, they will earn $50. If they sell as is, that's $40. They'll have a $10 increase if they do process it further, but their costs are $20, which leaves them in a deficit of $10. So they should not process the log into sawdust, but they should process the lumber further. And that is it for Chapter 12. If you have any questions, don't hesitate to give me a call. Thank you.